Hello and welcome to Livewire's Fund in Focus. I'm Ali Selby and today we're joined by Michael Higgins from Milford to learn all about the firm's dynamic small companies fund and some of the top stocks the team is liking today. Thanks so much for joining us today, Michael. Really excited for this conversation.
Thanks for having me.
To start off, there's obviously plenty of small cap funds available to Australian investors. What makes this fund different from the rest of your peers?
Milford's one of the largest boutique fund managers across Australia and New Zealand. We run around 24 billion under management, so it's a very big fund. And this is Milford's small to mid-cap stock picking strategy. It's been running for around 11 years, interestingly enough, but the Aussie Unit Trust has actually only been running for around 5 years, but it is the exact replica of the same strategy. I guess what makes us unique is that we have good performance and we are open to new investors. It is a little bit unique. Most small cap funds, they have a couple of years of good performance and then they close to new investors. We're sitting there now and we're top quartile over 10 years, 7 years, 5 years and 3 years. Wow. And we're actually open to new investors, which is a little bit unique. I mean, we've been closed to new investors in New Zealand for a couple of years now, so we've really ring-fenced some capacity in Australia.
Can you take us through a little bit about your philosophy and why you believe now is a good time to be investing in small and mid-cap stocks?
Yeah, I mean, small to mid-cap stocks are really exciting. You know, they're the founder-led businesses, the businesses that are growing, that we really love. Now, what we've noticed in small to mid-caps is there's a really large divergence between performance between large companies and small companies. And we're really at extreme levels at the moment. So, you know, we've got the likes of CBA and others trading at sort of 25 times PE. And meanwhile, small caps are kind of lagging relative to that large cap cohort. And what we see over time is mean reversion. We'll see some large caps coming back and we'll have far more favour into small companies, which is something that we're really excited about. But it's not always a one-way street. What's really important to Milford is risk-adjusted return. So we need to really keep mindful of risks out there. You know, we have an election coming up in a few weeks. Inflation's not tamed. We've got geopolitical risks too. So we do keep in mind some of those risks when we're positioning the fund. So like I said, those risk-adjusted returns are important.
I feel like investors have been talking about this reversion between small and large caps for quite some time. We haven't really seen it yet. Obviously, CBA is now the most expensive bank in the world. Why now? Why will we see a reversion now?
We think a lot has driven large cap growth because we've had a lot of money offshore looking for sort of Asia Pacific allocations and hasn't necessarily wanted to invest in China. A lot of that money's come specifically into the banks and driven them to very, very high levels. At the moment, like I said, we are going to see some mean reversion. We're seeing some really interesting companies out there in small cap land that are growing irrelevant of the cycle, that we think over time will certainly be reflected in valuations.
What are some of the core tenets of your investment philosophy?
So we're an all-weather manager, and I like to say that we're agnostic. So we've always, from 11 years that this fund's been running, we've always had a resources analyst, we've always had a technology analyst, an industrial analyst. We don't want to come to our investors in 6 months' time and say, oh, look, sorry, resources rallied the last 6 months, you know, we underperformed, sorry about that. We will tend to move, and we do invest across the spectrum. We incorporate a top-down view in the way that we invest as well, which really helps us inform how much risk we want to be putting on at any given time, but it also helps us inform where we might want to look for some really good investment ideas, whether we're early cycle or late cycle or what have you. It's a really good bit of an indicator or a guide for us to really tell us how aggressive we want to be in certain periods of time.
As of the end of September, the fund was holding around 9% cash. Why is that?
We don't run institutional mandates in this product. A lot of our peers do run institutional mandates, which mean they're sort of predicated to be, you know, 98, 99% invested at all times. They literally have to be. We don't. I mean, our historical invested position tends to be around 90 to 95% level. It's kind of where we're comfortable with. It allows enough dry powder for us to invest on opportunistically. But equally, if we do get nervous on markets, we can take that cash a little bit higher too. So it's a bit of a risk mitigation tool as well if the time comes. So that 9% is within the realms of normal for us.
Speaking of dry powder, what characteristics are you actually looking for in a business so that it makes its way into your portfolio and you actually put that dry powder to work? So we're agnostic managers. So it's a little bit irrelevant whether they're growth companies, they're value companies, they're resource companies. Essentially what's really important to us is, are we going to make money from these investments?
We're all really aligned at Milford. We can't invest personally, so if it's good enough for us personally, it's good enough to go in the fund. And that's our philosophy at Milford. Everybody at Milford invests that way in our funds. And so what's important to us is we are going to make money from it. Now, when I think back the way that this fund's been positioned over time, it's had a bias towards growth and quality, which is not overly unusual in a small cap manager. You want to get leverage and access to companies that are proving out their business model, but just haven't yet had the time or the capital to fully penetrate their addressable market. These are the companies that are going to move from small cap land to large cap land one day, and you can generate some really significant alpha from. So they're the companies that we're traditionally have done very well out of. But we're also cognizant we've also done really well out of some resources too. So we're not one way, and we are very agnostic. We don't have sort of specific requirements to enter the fund.
Are there any metrics that you would recommend investors look out for to find those sustainable growing companies?
We've had a lot of success in founder-led companies, funnily enough. We went back in time in our fund and reviewed it, and we found that we've never actually had less than 30% of the fund in founder-led companies. The likes of Chris Hulls with Life 360 that we own, or the Stokes' influence on Seven Group, which we own, or the Tudor Hopes with Macquarie Telecom. Again, a stock that we've owned and done very well out of. The stock that I'll mention now is actually Tuas. It's a Singaporean telco business. It's founded by David Teo, so that was out of TPG and was spun out on the Vodafone merger. Now, what we really like about it is the opportunity in Singapore and potentially in other Asian countries around Singapore. In very short time, they've gone from loss-making to profit-making at around $50 million of EBITDA. And they've done that by offering a really compelling product to consumers. They've undercut competitors. Tuas don't have a big legacy telco backhaul that they need to maintain and maintain high prices for. They've come in there lean and mean, prices 60-70% lower than peers, and have been able to get to 10% market share really quickly, which is something that we like. And then, as I said, if we think about it in a couple of years' time, it's all about potentially other regions that he can move into and do something similar to. So we're excited about that one. One of the other companies that's not a founder-led company that we quite like, but we think has exceptional management, is something called Ridley Corp. It's an animal nutrition company. It's a classic GARP, growth at a reasonable price business that we're invested in and have been for some time. 16, 17 times PE, growing double-digit growth too, and historically done so. So they're the sort of companies that we like.
Okay, what kind of returns have you been able to achieve by backing those types of companies, and are there any risks investors should be aware of?
Well, there's certainly risks investing in small caps in general, and as we've seen in the last couple of weeks, there can be risks in founder-led businesses in terms of what's happening in the media at the moment. So these are dogmatic people typically, but we find over time, if you back the right person, you'll end up doing really well. In terms of our performance, the strategy over 11 years is it's over 11% return on a per annum basis over 11 years.
Is that net or gross?
That's net, and which is about a bit over 5% alpha over the benchmark over 11 years in terms of the strategy. So the other metric that's important to us is upside downside capture, where we're all about risk adjusted returns at Milford, and so we're really pleased that we've been able to deliver above 100% returns in up markets, and then in down markets it's been around 70%, so a really good downside capture for that volatility.
How can investors access this kind of opportunity?
We're gold rated in Morningstar, we're recommended with Lonsec and Zenith, and I'm pretty sure we're available on pretty much all the platforms at the moment. You can also invest directly through our website.
Okay, well, thank you so much for your time today, Mike. It was lovely to talk to you.
Thanks for having me.
I hope you enjoyed that Fund in Focus. If you did, why not give it a like? Remember to subscribe to our YouTube and podcast channels. We're adding so much great content just like this every single week.